Matt, if you believe we're in a structural downtrend, then the top of this channel, you would argue, is not a good place to buy.
Well, great to be back. I feel like every time you guys have me on here, I'm bearish. So I don't want to be the Debbie Downer of the morning. It's funny you mentioned Apple, because we've held Apple in our largest and oldest ETF for 9 years and actually just sold it this quarter. So I'm feeling a little melancholy about that. But look, there's a lot of yellow flashing lights. And we've had stock valuations, which have been high for a long time. We've had the yield curve inverting. We have a big one, which is inflation. And a lot of people don't know, but stocks hate inflation. So historically, inflation above 4%, multiples get cut in half. Inflation above 7, it's even worse. And that's where we are. Will it stay? I don't know. You have all the other things going on. The meme stock craze, retail getting involved, high expectations. These are all yellow flashing lights. But there's one indicator that's really the final boss, right? That you really need to overcome before you get fully bearish for the red light. And to me, that's the trend. Well, the trend of the market has finally started to roll over January of this year. We'll see where we end month end. Things have been bouncing, tech and in the broad market. But to me, that puts it from the yellow flashing light to really the red flashing light category, where we call it the dark quadrant.
And so what changes that view? Is it a realization that we are at peak commodity pressure, or suddenly Ukraine gets resolved?
The problem with all the other indicators other than price is that price is the only indicator that can't diverge from itself. So value could keep going up. Stock markets can get more expensive. Trend is really helps keep you from being off the wrong foot. So if you go back 100 years and you put the stock market into the most simplistic category, cheap or expensive, and we can just look at 10-year PE ratios, uptrend or downtrend. The best quadrant to be in is in a cheap uptrend. Makes sense. You do like 17% a year. Amazing. The worst quadrant to be in is an expensive downtrend, where you do essentially zero. But the second best is an expensive uptrend. So that's okay. If stocks are expensive and they're going up, you do okay. The pain comes when you flip from being in sort of that expensive uptrend category to expensive downtrend, and that's when things can get really nasty, and that's where we find ourselves today. Now, we'll see how the next few days the market keeps going up. That may change, but for now, it seems like it's more time for caution.
Yeah, man, that's what I was wondering, because you laid this out in a post that you put up at the end of February, and you pointed out that something similar to the let's see, 200-day moving average on the S&P. We were down below that. But then in the last couple of weeks, since March 14th, the market has spiked up again. And now, I mean, have we gone from red light back to yellow? And is it just a question of how long we stay at the levels that we are here without going down to convince you that we're in a yellow light category now and not red?
Yeah. We look at things on the monthly time horizon. I don't like watching the markets day to day, hour to hour, minute to minute. That's too stressful for me. So ask me again in a few days when the month is in. That helps me separate the noise from sort of the signal. But the reality is you don't obviously have to just look at the S&P. There's plenty of other sectors. Like we compare this very similar to the late 90s, early 2000s. Market cap weight we think is crazy expensive. You can go hang out in value. We've talked a lot about that the last couple of years. We think there's been a real regime change really since 2020, where value stocks are finally having their moment again. And we think, back 2000, 2003, small cap value outperformed the broad market by 150 percentage points. And we think you have a similar setup today. So you can hang out in the U.S. stocks, just not market cap weighted. And then, of course, there's other things we think are really useful, like real assets and also foreign markets. But happy to get into those. But just anything other than U.S. market cap weight, I think, is a good prescription.
Shepard Smith here. Thanks for watching CNBC on YouTube.